Hello, Jens.
Hello, Theo.
How are you today?
I'm doing good, but I'm looking forward to the weekend, to be honest.
Okay, that's something to look forward to. How
Yeah,
was the Nvidia week?
so I had a short trade yesterday.
Okay.
It wasn't a big one, but at the beginning of the trading day, I think we immediately sold off below 500, if I'm not
Yeah,
mistaken.
yeah. Oh, yeah.
Yeah, and
That was
then
the
yeah, we held below the, I think it was the after hours lowest, let's put this in quotation marks, but there was kind of a consolidation 496, 497, and was like, okay, we're holding below this. If we drop 490, probably we are dropping today. But I think we can get the turnaround today, no, with Mr. Powell in Jackson Hole.
yeah.
Can he come to the rescue? Can he save us?
Man, I don't know. It's like in the indices yesterday, they were dumping all the currencies in New York session. Was a turbulence in the market,
Yeah, so well,
like a turbulence there.
to me it made the impression, I think I myself, I got a little more optimistic, let's say,
Yeah,
after Monday. Well, Tuesday we held, and then Wednesday, well, it looked nice.
yeah.
Then Nvidia comes out and they say, well, I think this is it for now, and this is now like shaking the tree. Let's see
Yeah.
who stays um who stays in it, and then,
Yeah.
but let's see. I
And as you
mean,
said, it will be interesting to see after the Jackson Hole meeting what's gonna on the scope from Monday onwards. Yeah. Also, it's end of the month now. Holidays are almost over. Bankers, institutional traders, they're gonna go back to the desk.
yeah.
Who knows?
Well,
Let's see what
but then on the other
September.
hand, I have to say, well, what does he want to say today? So what can he deliver? What we don't already know?
I don't know. Maybe to issue more student loans. Who knows?
Student loans is a good topic.
Exactly. So I don't want to take your time. I'm sure everyone is excited and waiting this webinar today to learn. So I
Oh yeah,
wish you
I have
best
to share
luck.
my screen.
Yeah,
Completely
yeah,
forgot. Yeah, there we go.
it's okay.
So today
Wish
we
you best luck
wanna.
and yeah, I'll talk to you next week again.
I look forward to it, Theo. Have a nice weekend.
Thank
Enjoy
you. You
yourself.
too, my friend. Thank you. Bye bye.
See you. So yeah, hello, and let me just take this off. I welcome you to today's Trading Spotlight webinar. So as you can see here, we wanna look at inflation, but the thing is, it's mainly it's mainly Jackson Hole we want to talk about, and what to expect from the speech itself. I have to be honest, I don't think it's a big event. It has been in the past. I haven't seen any stats, but what I know is, or let's look back 10 years, well, probably 13 years, probably 14 years. Jackson Hole was the place where QE was announced back then with Ben Bernanke. I think it was QE2, if I'm not mistaken. After the initial liquidity flush, let's say, following the great financial crisis 2008 with the collapse of Lehman Brothers. And so the thing is, till then, we think that this is the event of each year where something special and spectacular is announced, and that's most of the time it's not the case. So at least not as far as I think about it. I think we can look up. I'm not really sure. I haven't prepared something in terms of statistics around it, but I remember there was yesterday, I think it was, if I'm not mistaken, I think it was a tweet from Brian Shannon, if I'm not mistaken, a question around this. So usually he is a very technical trader and doesn't really look at these events, even though yesterday he asked, well, probably there's something in it for us. Let me just see if I can find the tweet, and then what do you have here? I think this could it. This looks interesting. We will go through this in a few seconds, and then we will see. Well, it doesn't really look promising at all. Probably what we can expect afterwards, but the day itself, not necessarily that we get big moves. To be honest. Yeah, let's look at this. This is probably of interest. So long thing short, we will use this because I think there will be hints towards inflation from Powell during his speech, and that's exactly what we want to focus on and where we want to point to, let's say. Before we start, first of all, I have to go with you through the risk disclaimer. So it could be that we're formulating a trade setup or something like that, and given that, chances are that in this context, then we will formulate kind of a scenario for gold, EURUSD, whatever that might be in it for us. The thing is that we are looking here at leveraged products, and they're not suitable for all investors. So please make sure that you understand all risks involved. Don't misunderstand anything I tell you today as financial advice. It's not. It's purely educational. It's purely informational. And if you have questions, you can ask all your questions. If you watch the recording now on YouTube, please feel free to comment below, ask your questions if something's not clear. But again, don't misunderstand anything as financial advice. It's not. It's purely educational content I provide to you. I don't think we need to introduce Admirals any further. I think everyone knows already. Great broker for over 20 years in the business. And if you are interested in more details, check out the website, admiralmarkets.com. Admirals, again, is considered to be one of the experts when it comes to CFD and FX trading, especially when it comes to DAX trading. I'm located in Berlin, in Germany, and usually we refer to Admirals as the DAX expert, in fact. One world, one broker in this regard. By the way, I just realized that I most likely skipped one slide, but I haven't prepared it yet. However, so what we want to focus on today is inflation. And the question, first of all, what is inflation? And then taking it from there. So we have this short theoretical introduction to be on the same page and understand why inflation is of interest, especially in the current environment. So what most likely actions will be taken to cool it down, respectively, to bring it up to some extent. And so the question is, what is inflation? In economics, inflation is a general increase in the prices of goods and services in an economy. And so when general price levels rise, each unit of currency buys fewer goods and services. So that's what inflation is about. And that being said, inflation erodes, obviously, the purchasing power of bonds' future cash flows. Simply speaking, the higher the current rate of inflation and the higher the expected future rates of inflation, the higher the yields will rise across the yield curve, as investors will demand this higher yields to compensate for the inflation risk. You probably have followed the financial media since COVID, at least, and how they countered or at least how they kept people, let's say, silent and to convince them to stay at home. They told them, okay, we lock down the economy, we advise you to stay at home, and therefore you get money and you can buy goods via online services, whatever it might be. And then an Amazon guy will deliver these products to you. He's immune in regards to any viruses, so don't worry. Well, however, the thing is, then if you do this kind of fiscal stimulus from a government and it's financed with liquidity, which is provided from a monetary policy standpoint from central banks, usually, and beside of that, you don't produce any goods. Well, obviously, you have lots of money chasing fewer goods, which means inflation is brought up. That's how inflation starts to run. That's exactly what we got to see, and I think it makes sense. Respectively, it's common sense, and we don't need to think about any further about this. The result of a running inflation could be seen beforehand. Unfortunately, especially central bankers and the governments around the globe didn't see it coming. So whatever they were taught in university, obviously that wasn't part of their lessons they got there. And then you have rising inflation, and what do you get now from central banks? And over the course, especially 2022, we've seen that very aggressive monetary and restrictive monetary policy from the Fed, for example, hiking rates aggressively. And so inflation is cooling down already. You can see this here. So this is a chart I screenshotted from Trading Economics, and I overlaid it with in blue you have inflation, and you have in the black dotted line you have producer prices. And so producer prices came down, as you can see here, already before inflation started to roll over. The same is also true. It started to rise producer prices before inflation picked up. And so the pickup in producer prices and that inflation is running hot. That was something you could already see at the end of, I'm not sure 2020, but I think it was 21. Early 21 already, after the first lockdowns, and after we saw some kind of let's come back to normal. My friend of mine, my best friend, for example, came out and said, well, it's crazy to see what's currently happening in the at the manufacturing side. So it's very difficult to get goods, for example, to build houses, but also in addition to that, you see a massive rise in prices. And so we could already see it coming. And it was already clear. And also when you went to the supermarket, for example, prices started to really push higher. And then especially the media, but also governments and politicians started to tell us that it has something to do with the war in Ukraine, early 2020, at 2022 here. So that was the last spike higher. That was potentially also something to take into account, but inflation got already out of control way earlier, after governments around the globe printed money, respectively, handed it over as presents to their people, while no goods were produced. However, to bring down inflation, what you have to do as a central bank is hike rates aggressively. And that's exactly what happened. And what brought inflation already down, but also consumer prices in general, producer prices in general. And now the thing is, and that's why I'm looking at this here, we saw a first pickup in producer prices already several months ago, and that was the first sign that probably there will be kind of a stabilization, and inflation won't cool down further back to down to the target of 2%. But instead, we will potentially see another spike higher. And the reason for that, you could really bet on this, was because WTI, for example, let's head over here to the MetaTrader and just have a look here at WTI. Oil prices started to bottom out above around 65 and then picked up from July onwards and started to curl up and trade up to new yearly highs, slightly marked new yearly highs. And if we break above this horizontal area here around 83 to 85, I think we are good for a move higher in WTI up to 90, 95 probably, which would be the highest levels since October 2022 in terms of WTI prices, oil prices. And since this is a very, very important factor in terms of inflation, well, we can certainly bet on inflation to rather sooner than later pick up. And also, and it's not just inflation itself, so consumer prices, but also producer prices potentially earlier. And why do I mention that? Well, because now the question arises, what can the Fed do? Because everyone is expecting the Fed to cut rates. Will this really happen? Can the Fed cut rates in such an environment? And I don't think so, to be honest. I think right now, given what we've seen, and I've been more positive and more optimistic in the past 6 months ago, because I didn't see this pickup in oil prices, at least not by nearly 30% from these lows around 65 back to 85 within such a short period of time. But the thing is, well, this is exactly what we get to see. And right now, the Fed has a problem, because the Fed can't really hike rates that aggressively. And the thing is that even if we're told in the US, but also here in Europe, for example, that the economy is doing great and everything's nice, and we shouldn't be too worried. The thing is, that's not the case, and the economy is not doing that great. And this is exactly the problem right now, also from a political standpoint, because now the Biden administration, for example, is looking into next year when we have the next presidential election. And you've seen already that they seem to be very, very afraid, let's say, in regards to the developments around Donald Trump. I never looked into this. I don't really know what happened there, and I don't want to be honest. I think this is just toxic to think about this and trying to dig deeper here. Whatever there might be, well, okay, whatever. So, but they seem to be very afraid of him. That's at least the impression it makes on me. What's happening there right now with him being arrested right now, and whether the charges are correct or not. But the thing is, this has something to do with the market overall, because I think that it's a clear sign that well, they are afraid for a reason. So they have nothing to show, especially in regards to economic growth and prosperity. And even, well, it doesn't really matter whether the Democrats are guilty of having wrecked the U.S. economy or they haven't. It as we know, it moves in cycles, and they are just now the people in charge and having and being the party who is what's the word for this? Representing, I'm not really sure whether this is the right word, but the U.S. president in this regard. And people are very well, let's say they are not deep thinkers, but they make things easy. They say, well, the Democratic Party is or Joe Biden is the U.S. president. He's a Democrat, and that's why and the economy is doing bad. Well, obviously he is guilty of wrecking the U.S. economy. Is it true or not? Well, most likely it's not, but that doesn't really people don't really care about this. They look at their bank account, their bank statement. They see, well, there's less money now, or I lost my job, or whatever, and then they say, well, obviously I don't want to vote for this guy anymore, respectively for this party anymore. So why do I mention this? The reason is simple, because you can be very sure that even if we are naive enough to think that the Fed is independent from the government, you can most likely bet that there's kind of a deal between those two, or that at least there are some people saying, hey guys, probably this course is too restrictive and it hurts the economy, and we have to give the people something. We kind of want to see some kind of economic growth or some kind of like prosperity, whatever it might be. So given that, and that inflation already came down, even though we didn't really bring it down to the inflation target of 2%, I think chances are there that this is something to keep in mind when the Fed, or how the Fed will respond in regards to the future monetary policy. I mentioned that because here I prepared something. It's the Fed Watch tool, and it's the Fed dot plot. So just to remind ourselves, we already went through these graphics in the past. On the right, we have the dot plot, and each dot represents a central banker, respectively an FOMC member. And the interesting thing here about this is that in June, with the latest economic projections, they brought this up by another 50 basis points, which came as a surprise, especially after the developments we've seen here in the banking sector in March. And so now the Fed already hiked rates up to 525 to 550, as we know. And what I have here is a so-called Fed Watch tool, which is showing us what the options market is expecting rates to be in, for example, June 2024. And as you can see here, with the likelihood of something to close to 70%, market participants expect the Fed to cut rates then. So it's 500 to 525. This is where all these columns come into play, and it's below 525 to 550. So I make this a topic because this is what the market is currently expecting. And then we look at what happened yesterday with this sell-off, and knowing that today we have Jackson Hole and Fed Chairman Powell speaking there. And let's have a look here. Let's take the NASDAQ, for example, and look at this very deep red candle yesterday. So just to put things into perspective, where we come from. So we are starting quite weak into the month of August, dropping, and see some clear, well, selling. This is a clear, solid selling pressure, and bears are in control here, which is no big deal because the market ran aggressively higher, starting from the start of the year, right, from January, and then we saw a pull in here. That was in March, like volatility in the banking sector, let's say, and Signature Bank, and what else did we have? Signature and First Republic. Who else? I forgot one, I think. Silicon Valley, that was the initial bank. Coming down, the market is already saying, well, we can't really hike any further from here more aggressively. And the market was already expecting rates to be around 4, probably even below that in December. So 9 months from here. And then the market started to rally again. So crisis is not there, or bankings are not failing, whatever. And the market is taking off. And then from, I think it was mid-May till like the end of May, we really took off. And in case of the NASDAQ, from the start of the year, we were coming in at 10,700, topping here around somewhere 15,000, 16,000 or so. So this is like close from the start of the year till here, it's close to 50%. And now we're coming in. We're coming in, and finally there's kind of a corrective move. And then market participants start to really think of, well, but probably we are about to see a bigger corrective move, whatever. And then at the beginning of this week, we start to curl up a little. And what's interesting, and what you can see here, but well, we'll probably let's take this one here. Very short term, very, very short term. It's an exponential moving average, but well, fair enough. What I have here now is a very short-term moving average, exponential moving average. It's the EMA 5. It's the 5-day moving average. And as you can see here, we are continuously holding below. There's some attempts to break back above, but we are sold off again and hold below. And then here you can see at the beginning of this week, Monday, we closed above. That happened in the past. But we weren't rejected below that, like here. That was on the 14th, respectively, on the 15th of August. This is like last week, Monday and Tuesday. But we held here, and then we took off on Wednesday. That was cool because that was a clear sign. Okay, buyers are back in control now. That's a very rough way to look at the price action. And then the Nvidia earnings hit, and they came in crushing and better than expected, and gapping even further, which is very strong because given what we've seen here 5 months ago, 3 months ago, with a very strong guidance, which was already above 60% above what the Wall Street expected. And so no one was really expecting that. And then we come in, we gap higher. We are already seeing a push higher in the NASDAQ, but also in the S&P 500, pushing higher, and then we are selling off. And hand in hand with that, what we see is that 2-year yields are also pushing higher and closing back above 5% for the first time in at least weeks. And that's a surprising sign because what we know is that 2-year yields are very, very strongly and positively correlated to the rates from the Fed, short-term yields in this regard. And seeing yields rising right now there's a clear message within that, because it tells you, well, we expect the Fed to stay high with rates for longer. That's what we expect from a certain guy who's holding a speech tomorrow in Jackson Hole, who is Jay Powell. So the market is communicating, well, we don't really see the Fed cutting rates. And this is exactly, in fact, what we are now focusing on in the next 30 minutes. So we won't have a webinar then anymore, but we have to, by the way, I just have to, 1 second, please. I have to write something down in regards to my trading. So 1 second, please. Because when I end the event here, I potentially will also trade stocks in this regard, and to make sure that I can really write down everything as I need it to review my trading accurately. I have to write down some pre-market volume numbers here, and just by the way, let me just check. Anything else? No. So my main focus is in fact today on Marvel Technology. I'm not going into further details, but the stock is very interesting. I think after the gap below 56.57, which is the low of a range, which we developed after earnings and the NVIDIA guidance. It's also a play in the semiconductor space. And now we're breaking out of this range on the downside. And if we hold below 56, 57, and potentially get some kind of bearish catalyst from Powell, then, well, we are probably good for a play on the short side. But that's something completely different. So now the thing is that I interpret the price action from yesterday in exactly this way. And by the way, let me just here share this graphic. It's within a thread from Brian Shannon that was mentioned yesterday from a guy who is working at CNBC, if I'm not mistaken. And that's interesting because it's perfect, in fact, because it perfectly illustrates what we can expect from a pure quantitative side here from Jackson Hole today. So I give you already an idea on why this matters, because what Powell won't certainly say is something like, or it won't really change anything we've heard so far. I think it's to me it's no big deal, this speech at all. But what we know is that the market is obviously expecting something, because inflation came already down, as we've seen in the presentation, and yesterday we saw this massive run lower here from an overall more optimistic picture we could paint based on what we've seen from Monday onwards. And then seeing this massive reversal here and breaking below the support, which we found around 14,800, 900, something like that, on Tuesday, that was a clear bearish sign, in fact, and something to keep an eye on, to really focus on. And well, let's just see what happens. If he points something out, most likely it will be around inflation. If the interpretation from his speech goes in the direction that market participants would say, well, he somehow mentioned inflation and it's coming down already, and we are having right now rates which are significantly above the current consumer prices, which came in something like 3.2%, if I'm not mistaken, 2 weeks ago. And we are like 200 basis points with rates above that level. Well, this is probably already giving a good idea on that inflation is most likely to come in lower, even if we currently probably see some spikes higher. And now what we, based on, for example, what we've seen in oil prices, but now the thing is that we have to just wait and see whether this is the rhetoric being used and how the market responds to this rhetoric. And it will most likely be around inflation. In general, and that's why we want to have a look here at this, by the way. So what I said right at the beginning here was, I'm not really sure if, how can I say that? I'm not really sure whether Jackson Hole itself is a market moving event, and this is illustrating it. I think the main reason why the market is so focused on that is because, especially here in 2010, we've seen a massive run higher, as you can see here. So that was the 27th of August, 2010. As you can see here, 1 week later, we traded 5 0.5% higher. So the question is now, why? And by the way, okay, well, we could argue similarly if we go to last year, minus 6.5%, but this was a bear market based on the very restrictive stance from the central bank, the Fed in this regard. So what happened back then? Well, it was the announcement of QE. In fact, it was the announcement of QE2 from Ben Bernanke back then. And well, we connect Jackson Hole to exactly that and say, well, that's why it matters. And that's why there's lots of volatility. If you carefully watch here, you can see, well, I'm not seeing any big moves here. Well, we're taking out 2010, probably something like 2% higher, which is already a lot, but sometimes even unchanged 1 week later. So like, I'm not really seeing big impulses here. But all in all, as you can see here, positive 2 weeks into Jackson Hole, negative 2 weeks into Jackson Hole. Win ratio for positive 2 weeks here in this regard, 77%. We are most likely going higher from here. That was at least what we've seen in the past. And what's the average? We are going higher 2 weeks from here, 0.9%. So like 1% higher. While if we trade lower, which is 60% of the cases, happen more often, let's say 2 weeks, 2 negative weeks. If we traded lower, then it was minus 0.8%. So like, it's not such a big event at all. It could be different, certainly, but I think the main reason is that the reason why we connect something more volatile to Jackson Hole here is because of this event, especially in 2010 and QE2, and it's most likely a so-called cognitive dissonance. So I wouldn't really weigh too much or lay too much weight on what we are currently seeing here, but in fact, wait for what the market delivers, what the speech delivers, and then see whether we trade higher or we don't. Let's just take it from there. In fact, by the way, let me just check here. Okay, that's very interesting. It's very interesting. Okay. So in fact, that's it. So that's in fact it around the current developments here. So we are focusing on inflation. And this is most likely that Powell will say something towards like we are still a long way to go. We don't know whether inflation will come back down within the next 12 months to our target rate of 2%. Let's see what happens, blah, blah. We don't know. And the market is then interpreting these words. And given the price action here, we really have to carefully watch based on price levels, what we get. If I look at the 5-minute chart, for example, right now we're coming in bullish, which is, by the way, I don't really want to see that. I don't want to see a bearish spike either. In case of if I'm a bull, I don't want to go bullish into the event itself because there's a risk that it's an anticipation already here and that we are then selling off. But from a pure market-wise perspective, I would say, well, the lows yesterday, they came in somewhere here. It was around, 14,800. If we drop 14,800 below yesterday's lows and hold below, well, I think there's a clear risk then that we are probably trading lower from there. And well, most likely going to a 30-minute chart probably. Well, most likely in this context, then we'll get to see another test of 14,750 in case of the Nasdaq, and probably even lower than that, and retest the area of last week's lows around Friday, the pre-market 14,500. So that could be a clear bearish sign. Right now, I wouldn't weigh too much on the price action we get to see. So right now, it's just like, well, we trade higher, we trade low, whatever, and then let's just see what comments and Powell delivers, because this is when the deck is completely reshuffled. And then, well, we will see what the market makes out of this. If there's any hint that we are done and there's no further rate hikes, and most likely we'll get to see any signs or any kind of rhetoric which points towards, well, we are about to already discuss behind closed doors what we want to see to cut rates. This could be like the starting point for a sharp rally into the close, or into the weekly close in this regard, and helping to make back most of the losses we've seen from yesterday. If no such thing is communicated and the market is disappointed from the used rhetoric, well, this is then most likely a reason to be skeptical and seeing a sell-off into the weekly close, with the first target around 14,500 and probably even lower than that. And yeah, well, that's in regards to the Nasdaq. I really want to focus on the Nasdaq because I think it's more yield sensitive. And that's why I think the risk reward, respectively, the chances for it to get to see the biggest bang for the buck, probably, that's probably a good way to put it, is something you get in the Nasdaq. We also could certainly here have a look, keep an eye on EURUSD. I think very interesting. This is, by the way, it's a 200 MA. Well, let's just see. It's a simple moving average. Yes. So very interesting because most recently we pushed to the highest level since 2022. Yeah. Since the start of the beginning here of the, well, or close at least, of the invasion in the Ukraine from Russia. We pushed to the highest levels and then we sold off because the US dollar started to well, the US dollar started to show some signs. What can I say that? Of a stabilization. That's probably a good way to put it. And that was also potentially the main driver for the recent weakness and this downtrend we've seen here in gold. And the interesting thing around this, I think, is, let's go back to the EURUSD. That right now we come to, let's say, a 30-minute. I'm not sure if this is, let's say 4 hours. This is probably a better way to look at this. Hello. Okay, there we go. So you can see here it was some 0850 around a level we held yesterday. So there was a quick flush below that, and then we were bought back. There was a PMI. European German PMI, I'm not really sure, which pointed to further weakness in the European, respectively, especially in the German economy. And then we bounced back, but sold off again and held lower here, going hand in hand with this spike higher in 2-year US yields above 5%. And now, well, we dropped below 108 again, and now we are coming back a little. And the interesting thing will be in which direction the rhetoric from Powell leans. If he comes and says something like rate cuts, I would say we have a realistic chance to bounce back above 0850. If we hold below, I think chances are good that we are not yet done on the downside, but have further room to go, probably down to 07, probably even 0650. So the area here around these June lows around. So that's certainly something to keep an eye on. So far, there's a clear sign that the EURUSD is in a short-term bear trend after this move higher here. We are now clearly seeing a sequence of falling highs and falling lows. And so the thing now is, which direction does the rhetoric from Powell go to, and into which direction? Anything like we are done hiking rates, more dovish, something like hinting towards rate cuts from the middle of mid-2024, which is also something which I consider, at least initially, bullish for equities after the recent sell-off, is something to drive the US dollar lower and EURUSD back above 0850. Everything, any rhetoric which is like hinting towards like we keep rates at the current level, probably there's even further rate hikes, is something which would favor the the US dollar over the euro, and most likely initiate then a push down within the next weeks to 0650, 07 on the downside as a first target. And finally, probably certainly also gold is of interest for us. So what I consider to be interesting in terms of gold here is that I would say we've seen this downtrend developing after we failed to break above 1,985 and coming down to the 200 SMA here in this regard, undercutting it slightly, going below 1,900. And then there's no further downside, but instead we bounce quite hard. And not just that, but if you carefully watch of what we've seen yesterday with US dollar being bought and knowing that gold and the US dollar are usually negatively correlated to each other, which means like US dollars rising, gold should drop and vice versa. Well, then you see that therefore gold held quite solidly, let's say. And that's definitely something to keep an eye on, because I would say seeing gold holding relatively strong and the option that there's a more dovish stance from the Fed, this could lead to a quite extended rally on the upside, especially if we break above 1,922. I'm not, well, let's say I'd be careful, but still I could imagine that gold is probably good then for a push up to 1,950 probably into the weekly close already. And probably this is also the starting point for a push up back to 1,985, probably even a break higher than that. On the other hand, we need to see what happens if there's a reinforcement of yesterday's obvious, more restrictive expectation. If Powell delivers something which underlines that, that's usually something which is very bearish for gold due to higher yields, or at least higher yields for longer than expected, anticipated. If that happens, that could lead to another drop back below 1,900, probably even a drop below 1,885, which could then trigger further downside, probably 850 something on the downside, 1,850. That's probably a good area to watch out for then on the downside. Not necessarily today, but with a trending move over the course of the next days, in fact. And so I hope you feel well prepared now for the speech of Jay Powell in Jackson Hole in around 20 minutes from now. Again, don't expect too much, but like the main focus, the main question market participants have right now is there any signs that the Fed will start cutting rates from mid-2024 onwards? If there's no clear signs, well, this could mean that we are higher for longer. Higher for longer means higher rates for an extended period of time, which is usually not that positive for equities, but also more bullish for the US dollar, respectively bearish for gold, which means EURUSD could continue to drop while gold could see a pushback below 1,900. And the NASDAQ, for example, could see another flush on the downside and another retest of 14,500, and vice versa. Any signs? Well, we're done. Inflation is coming down, which he most likely won't say that clearly, but any signs which is like bringing yields back below 5% in case of 2-year yields is most likely to reverse at least some of the losses we've seen yesterday in the NASDAQ. And that's it from my end. So happy trading. Watch your stops. Keep an eye on the speech from Powell in Jackson Hole. And I hope you learned something. Talk to you again next week. I really look forward to it. All the best. See you. Bye-bye.